So we're going to get the Forex Bible out again today, which is this. And we're going to go through a bit about what I teach on day one. So, of course, same as yesterday, risk management, very important for us as traders. I'm going to start with that. So there's a massive misconception about lot sizes. A lot of people seem to think it's the way to trade is to use the same lot size for every single trade. That isn't the case because your stop loss will be a different size for every single trade. So, for example, if you've got a trade of 30 pip stop loss, and let's say for argument's sake it's just £10 a pip, and you hit stop loss, you've lost 300 quid. The next trade you're in and you have a stop loss of 20 pips, you hit stop loss, you've lost 200 quid. The next trade you might have 100 pips and you could potentially lose £1,000. So there's no continuity there, is there? It needs to be systematic. And the way we do that is that we risk a percentage of our account for every single trade. And that will either be 1 or 2% is the most logical to use and relatively low risk. The larger your account gets, obviously you become into more of the 1% bracket. So you can't just say on this trade it looks good, I'm going to risk more, or this trade don't look as good, I'm going to risk less. You need to stick with 1% or 2% for every single trade, regardless of how you feel about it or how it looks. That's one little tip and one little technique that we can use to stay consistent. Okay, we need to risk the same amount of percentage for every single trade. That's really important. And that all comes under our risk management strategy. So we've got a strategy on the charts to find the trades. We also need a risk management strategy as well. Okay, and they all key in together. That's what helps us become successful traders. So risk management, really important. I'm going to jump into the Forex Bible now. I'm going to go through a little bit about risk management and pips. Let's just take a look, see what page we can start, which is going to be the best. Cool, yeah, we're starting a little bit about news, I think. So I'm going to jump into the screen share now. Risk management, really, really important that for every single trade, you implement the same risk management strategy. Now, let's go to the start. Here we go. So first of all, the very, very simple basics is knowing when and when not to trade, right? So we want to know when is a good time to trade, and we want to know when is a good time not to trade, because it could be a bad time in the market. So one of the easiest ways to do this is literally looking at the high impact news, which I'm about to discuss a little bit now. So I'm just going to read this off the Forex Bible. Okay, so the trading session with the highest frequency of transactions is the London session. Because of the high volume of transactions throughout the London session, this creates a very liquid market and provides many trading opportunities. So there's more movements going on. Okay, the markets can move pretty fast, which is good. That's what we want to see. And we can look to capitalize on those moves, which is great. And most of us are from the UK that are watching this mini series. So we're in a good place to trade. For those who aren't in the UK, it's not a problem. You'll catch your own sessions. But we're a bit more luckier because London session is the best session to trade, right? Some may say different, but it's the most heavily traded session. So there is going to be more opportunities. Okay, so because of this, our preferred session to trade is, of course, the London session. So when do I want to trade? Predominantly in the London session, right? Okay, so when the Asian session comes to a close, that's when the Asian session crosses the London session in the morning. It's about an hour kind of overlap. That can cause uncertainty in the markets, including large spikes, some manipulation spikes, some very short-lived reversals. And what a lot of more experienced traders seem to do at this period is they see a big rally, big candle pushing. At that crossover period between about 8 and 9, they'll go, brilliant, buy. What will happen? The candle come all the way back and leave a really big wick and take them out the trade. So if you're not an experienced trader, try not to fall for those tricks in between 8 and 9 in the morning. Now, this isn't going to be every day, but if you just watch predominantly GBP pairs at that time in the morning, you will see these big moves. Now, there is strategies that we can implement to catch these moves, but when you first start trading, it's best that you stay away from that kind of 8 to 9 period and use that time to do your analysis in the morning if that fits in with your schedule. Okay, you don't want to be caught out in any fake moves, which moves me on to we only trade when a candle's closed. Okay, so if you're seeing a candle going, you're not going to take the trade anyway because the candle hasn't actually closed. It's still active. So you only know the identity of the candle once it's closed, right? So that goes hand in hand with that. Okay, never have fear of missing out and just jump impulsively into a trade because you can see a really big candle pushing. That's not going to work for you. It's not a good strategy. All right, so at the moment, we're going to trade London session. We don't want to be caught in any fake moves, so we're going to wait until a candle closes. Okay, and we also make a conscious effort to be aware and avoid high impact news releases. So trading around high impact news or even trying to trade the news sentiment is very much like gambling and gives us no edge over the market. So a lot of people think they can trade the news and they can look at all this data online. I've looked into this a lot a couple of years ago. You know, I was thinking, you know, there must be a way with the news that comes out. It can push the market so significantly. In my opinion and my research, it does not work. There's so much data online which is inaccurate. How can you trade off of that data? Okay, the data I'm interested in is what data is on the chart. So what I do to stay away from the high impact news, I go on forexfactory.com every morning before I perform my analysis, and I look at the following 24 hours of the high impact news. So for example, if there's GBP news at 9:30, I'm not going to be taking a GBP trade at 9 a.m. because I know this is gambling. This could push the market anyway. Okay, I'll just wait for the news to pass, let the market settle for about an hour after, and I'll continue with my trading. Now, if I am in a trade and high impact news is approaching, if the trade's in profit, you can either close in profit or move stop loss to entry and even take partial profits. Or if the trade's in a loss, you can cut your losses, or you can take the gamble and hold through the news if you've accepted that you could potentially lose 1%. Okay, the safest scenario is, of course, just close out the trade. All right, if you don't want to get caught out. From my experience, I find this works. And however you're going to approach high impact news, try and stick with that. A lot of people just want to hold through it. Once you enter a trade, you fully accepted that you could potentially lose 1% or 2%. So, you know, you can just hold through the news and take your chances. Okay, so in a nutshell, London session, ideally not between 8 and 9 in the morning, and look at the high impact news calendar on forexfactory.com. This is going to give us a really good schedule for the day, and just make us aware of what news is coming out, because you might want to enter a US dollar trade at 1, but then there's news at 1:30. You won't enter the trade. Okay, and more often than not, news goes against us. It really does. It's mad how that happens. Every now and then it might go our way, and I don't want to base my trading on if, buts, and mights. You know, we need as close to a sure thing as possible, which is why we take these precautions. Okay, so the next thing we need to talk about risk management is your lot size, and this is a question that I'm asked literally daily. How do I work out my lot size? I'm struggling with my lot size. I'm not too sure what to use. Or the biggest one is this trade looked better than all the others, so I thought I'd use a bigger lot size. Obviously, a bigger lot size means you're potentially risking more than your allocated risk percentage, and you don't want to go over your allocated risk percentage no matter what. So a key part of our strategy to help us maintain consistent profits is knowing our perfect lot size per trade and what our percentage risk should be. Okay, knowing your percentage risk per trade is your own personal preference. All right, mine's 1%. The recommendation for percentage risk is 1 or 2%, as I've previously discussed. That's maximum per trade, and ideally no more than 6% risk at any one time. Now that doesn't mean you're going to keep loading up trades on Euro USD. You need to diversify. Okay, so for example, you can scale into a trade, which if you do that, it's absolutely fine, but you need to make sure your first trade is at a break-even position. So you've already moved your stop loss to entry, making your first trade risk-free. Then you can add another position on to your current trade. Okay, so you're still only at that 1% risk. Now, the 6% risk at any one time means, for example, you might have a CAD yen trade on, a Euro USD trade on, and a GBP AUD trade on, for example. So you've diversified what you're trading. All right, it's all about protecting our capital, not putting all of our eggs in one basket. For example, if you've got Euro USD, GBP USD, USD CHF, and USD CAD, you're at 4% max risk, and then Trump tweets, and no joke, Trump's tweets can make the market move crazy. Okay, he used to say stuff all the time, obviously, about the China tariff trade war. That used to make the market move a hell of a lot. That means if the market doesn't go your way, you've just wiped out 4% of your account. All right, you don't want that to happen. So it's important that you diversify what you're doing. Okay. Next up. Okay, we know what we want to risk now. 1%. Okay, 6% at any one time. Really important. Then we don't really go higher than that. That is a bit more on the high side anyway. Let's go back. Okay, so only 6% at any one time, and that's diversifying your instruments. Okay, what pairs you're trading. Okay, so you're either a 1% trader or a 2% trader. Okay, you cannot alternate between the two. Okay, so if you say now you're going to leave this webinar, this mini lesson, I'm going to risk 2% per trade. That's you. Okay, you're going to risk 2% per trade now. You're not going to alternate between the two because that's not consistent. Consistency is key. Okay, so we aim for no less than 1 to 2 RRR, which means risk to reward ratio. Now, risk to reward ratio is really important because if you're getting minimum 1 to 2, you can actually lose 50% of your trades and still be profitable. So say, for example, you've lost 5 trades in a row, then you win 5 trades in a row, you've actually made money, which is fantastic. So which means the higher the risk to reward ratio, the less trades you've actually got to win to be profitable. So again, that's putting the odds in our favor. We're looking out for high impact news. We know we're going to risk the same percentage every single time. We're watching out between 8 and 9 in the morning flows, fake moves. So we don't want to be caught out by them. We're going to be checking the news and also looking for minimum 1 to 2 risk to reward ratio. So before we've even opened up a chart, we've already got this strategy in place to help us have a successful trading day. A lot of people just want to open up a chart and just start firing in some trades. They haven't even got a strategy ready to input. And that's what this is. It's having that risk management strategy to give you the highest probability of a successful trading day as possible. Okay, and that's why risk management is so important. Okay, so lot size. Now your lot size will change in value in accordance to your stop loss size. So there's a formula to work this out, which I've got here. So feel free to screenshot this. Now this formula will only give you an approx figure. That there is calculators out that you can use online, which would be a lot more accurate. But this will give you an approx figure of what your lot size should be. Now the lot size, for example, using 1.0, that will actually be a slightly different monetary value in comparison to using 1.0 on Euro NZD to GBP USD. Euro NZD, it might be actually £6 a pip, but GBP USD, it might actually be £8.50 a pip. So it will alternate slightly and also depend on your broker's leverage. So that's why it's important. You can use these calculators online, which are pretty good. But to know your lot size, I've got a guide on the next page, and this guide I've worked out on a calculator, so it's pretty accurate. Okay, it's all going to be approx, good averages, but it's pretty accurate to be honest. So here's a simple formula to work out your lot size. So you get your account size. Okay, if you're risking 1%, you times your account by 0.01, which is going to give you 1% of your account. Okay, then that 1% of your account, you're going to divide by your stop loss size. Okay, so say it's 30 pips, you're going to get 1% of your account, divide it by 30 pips, all right, which is going to equal your approx lot size, but then divide that by 10, okay, and that would be your lot size for a CFD account, okay, which pretty much most of us trade. Okay, so it's 1% divided by the stop loss size in pips, so 1% of your account divided by 30 pips, for example. The answer to that, divide that by 10, and that will be your lot size. Okay, you need to do this for every single trade. This is a very approx formula at the bottom, so it will be a little bit out, but it works as a good guide. Okay, so see the lot size identification guide on the next page. So this is pretty good. Okay, I've annotated it as well. Now it took a bit of time to make this, but it works. Now on the lower end of the scale, for example, this represents just £1,000 account. The reason why I chose £1,000 account, because if you're trading 10K, you can just times these lot sizes I have on here by 10. Okay. If you're trading £500 account, you can just divide this by 2. So I thought £1,000 was a good solid round number for people to be able to work out the lot size from this spreadsheet. Now, you can download this inside the Golden Suite if you remember. It's yours to keep. I'm here to help. Now, down the left-hand side, you're going to see the currency pairs. Across the top is your stop loss size in pips. then of course the gold numbers in the middle is what your lot size should be. So you will see, for example, 0.061. Now you actually can't enter that in. So you just enter in 0.06. The reason why I've had to write the number in its entirety is because you've had a 100 grand account and you times that by 100, ends up being 6.1. Okay, so it's important that I added those end numbers in there for when you're looking at the larger end of the accounts, because they will make a difference. All right, they're going to make a difference. And by the time you get bigger and bigger and bigger, if I didn't put the end number on there, it would be getting further and further out from the true value. So if you do go and use this spreadsheet, you go on Metro and you go, oh, I can't put in 0.061, you're just going to be trading 0.06. Okay, it's so small at that level that one at the end will be so tiny. Okay, so don't worry about that if you're wondering what's going on there. But this is pretty accurate. Okay, I've tested it, I've tried it. It's pretty good. There will be some very slight discrepancies depending, obviously, the broker that you're using, your leverage, all that sort of stuff. But again, it's a good guide. Okay, it's a good guide for you. So if you haven't screenshotted this, make sure you screenshot it. You're welcome to. If you want to download the actual PDF, you can inside the Golden Suite. Now, these guides, you need to, you will start to kind of know what your lot size should be, because one, you're going to get your favorite pairs that you like trading. Two, your style will start to allocate, an approx stop loss size. So you'll be like, oh yeah, my stop loss is roughly 30 to 40 pips usually per trade, for example. And then you'll know, I like trading Euro NZD, for example, so I know my lot size is always going to be X. So you won't need to look at the guide all the time once you start going with it. Okay, so once you start to learn, you start to know. It's not like you've got to keep pulling a guide out your pocket and looking at it. But first, it's there to help you. All right, so risk management, before we get into pips, when and when not to trade, we're going to check the high impact news before you do your analysis every day. Check what's going on. This news is going to impact the market. It is going to push price one way or the other. For an intraday trader, I need to know that. So anything that's in red on forexfactory.com is what we want to avoid. Okay, I'm not going to say there's news at 5 o'clock this afternoon, for example, and it's now 9 in the morning. I'm not going to avoid US dollar all day because of that. I'll still trade US dollar. I just won't trade it right before the news. I won't be looking to trade from like a couple of hours before, for example. Okay, so don't let it completely disable you from trading. Just be aware that it's there and don't place a trade right before the news, because there's a good chance it could go the wrong way, because some brokers float the spreads really high around the news as well, to stop people from trying to trade it and make some quick gains. So you've got to be aware of that. 8 to 9 in the morning, if you're an inexperienced trader, it's not the best time to trade because you can get those big fluctuations. There's not always opportunities to take first thing in the morning anyway. So just be aware of that as well. So roughly 9 o'clock onwards, you've checked your calendar. Okay. You're going to know your lot size, 100%. You've got the guide there. You know what your risk is now, either 1 or 2% per trade. Really, really important that you stick with that, because all these little details now is what creates that bigger overall picture for a trader. So all the time we've got to be looking at the little details. It's so easy to overlook simple things. Like a lot size, which is a big deal, by the way. So no more than 6% risk at any one time, and that needs to be diversified, not all on the same currency. All right, and we've got our guide here as well, which by all means you can screenshot and take away with you. So risk management, I'm not going to get into it massively deep because it's something I can talk about for hours. But here, in a nutshell, this is what you need to know. It'd be good to go away, do your own research. Or if you want to know a little bit more about it, feel free to message me on Instagram, goldensuite_Ryan. Happy to help. So let's get into pips. Before I get into pips, any questions about risk management? You can ask in the bottom. So you can ask in the bottom of the chat. How many trades do you open at once? Well, that does really depend on the current market conditions. So, for example, I might have a couple of trades running at once, but if I do see another good opportunity and it's on a non-correlating currency pair, for example, if I'm in AUD USD and I see an opportunity card on NZD USD, I wouldn't necessarily take that because I know they're going to move roughly the same anyway. So again, it's adding to that risk. I don't want to do that. But if I'm in AUD USD and I see a Euro NZD trade, yeah, I'll happily take that. Then if I see a GBP USD trade, then yeah, I'll potentially look to take that, you know. So just diversifying a little bit. The same with EA and EN, you know, I wouldn't necessarily look to take both of them at the same time. I mean, you can, but you just need to split your risk. So if you're risking 2%, you can put 1% on each. They're going to move pretty much the same anyway, but you can diversify that way. All right, it's all about not opening ourselves up to too much risk. I mean, a lot of people think more trades, more profit. It's really not the case. The more you're trading, the more you're at risk. Because you're continuously in the market. So you need to be a little bit aware of that. You know, if you're in the market all day, every day, and you're trying to manage all these pairs, you're not going to be on the ball, which means you're putting yourself more at risk because you're not going to be as sharp. Where if you've just got a couple of nice trades running, you're organised, you're watching what's happening, nothing's in a fluster, you can manage your trades accordingly. Okay, it's quality, not quantity. Where will we enter our lot size? Yeah, MetaTrader 4. So at the top of MetaTrader 4, you'll see the lot size navigation right in the center, and that's where you're going to put your lot size in there. There's a few videos on this in the beginner section inside the Golden Suite. You can access it for free, which will help you with that. Can you please tell us more about pairs that correlate? Yeah, so there's many pairs that correlate. The main ones that I focus on are GBP AUD and GBP NZD. They correlate very closely. So write that down. It's good to know. Euro NZD and Euro AUD also correlate very closely. You've got AUD USD and NZD USD also correlate very closely. So I'm just going to go through currencies. I'm not going to get into metals. And also the DXY, which is the dollar chart. Okay. DXY, which is the dollar chart. That has an inverse correlation with Euro USD. So if Euro USD is, if dollar's going up, Euro USD will be going down. Okay. So they have the opposite correlation, inverse correlation. They're the main pairs that I look at. You've also got like USD Yen and USD Swiss, which also closely correlate. But they're not pairs that I'm massively trading. Can you go 1%, 2%, 4%, 8% if losing to win a trade, then go back? So you kind of, it's just like the, is it called the martingale method or something? You use on roulette, right? So you do £10 on black, it don't come in. You do £20 on black, it don't come in. You do £40 on black. No, it doesn't work with trading, unfortunately. Eventually you run out of margin and then you've blown your account. So yeah, definitely don't do that. And the more risk you're putting on, the more it plays with your emotions. And yeah, it doesn't work. Many people have tried this and you fail. Okay, it might work for a little bit. Don't get me wrong. It might work for a bit. Eventually, boom, you'll lose your account. It's not a consistent method. So yeah, don't do that. Is there a minimum amount needed or required to open a trade? Yes, you will need a minimum amount because you need margin. So in terms of what the absolute minimum is, I've never tested that, so I wouldn't really know, but £100, you can definitely place a 0.01 lot size trade very comfortably with enough margin and leverage if you had a reasonable stop loss. So if you're just practicing and you don't want to fund an account, you can open up a demo, or you can just put, there are some brokers which take a small amount. I placed a 0.01 trade on 60p capital. There we go. So could have had a really good bit of leverage. That's pretty low. So basically 0.01, give or take 10p. So depending on what spread you had with that pair, you might have got taken out the trade straight away. So it's pretty tight. First time I blew my account. Well, it happens, mate. But as long as you learn from it, it's a lesson learned. Okay, it's a lesson learned. So I'm going to jump into pips now. Because I know a bit about risk management, let's get into pips, because that goes kind of hand in hand, because we need to know how to work out your stop loss size and obviously your take profit size, which is what we do with pips. So let's jump back on. Pips explained. Now, there's a couple of mistakes that a a lot of people make with pips, especially at the start of their trading career. Now, we need to know exactly what the pip is. It's very important, otherwise you'll make the mistake of not working out the correct size, the correct lot size or the correct stop loss size, which you don't want, okay? It needs to be accurate, okay? We're trading now, you're using your own money, we're trading the financial markets, it needs to be accuracy. Okay, so pip means point in percentage. Pips is a unit of measurement to express the change of value between two currencies. When the market's going up and down, we can measure that distance. Okay, so we think price is going to go from point A to B. We can measure that distance. We say, okay, that's 100 pips. I need my stop loss to be 50. Perfect. 1 to 2 risk reward ratio. I'm risking 50 pips to get 100. So as a good example here, if Euro USD moves from 1.1300 to 1.1301, price has moved by 1 pip. Okay, the last digit, okay, the end number increased by 1. Okay, that's all we're looking at. It's increased by 1. There is a number after that. It's called a pipette. Okay, that's the 5th number after the decimal place. We're not interested in that. It's so tiny and insignificant. I don't even look at that number. I'm only interested in the 4th number after the decimal place. Okay, so a pip is usually to the 4th decimal place, with the exception of yen, which is JPY. Currency pairs where we will find the pip to the 2nd decimal place. So yen is a bit different. For example, it would be 135.50. Okay, and the last number, the O, that's the pip. That goes up to 51. 1.35.51. We've increased by 1 pip. All right, I hope you understand that. We're going to do a bit more now anyway. Okay, so the unit we find after the pip is called the pipette, and 10 pipettes equals 1 pip. So you can imagine how small that is. Okay, so we disregard the pipette as the value is so small. Okay, so got an example here. Let's say the price of Euro USD is currently 1.13001. Okay, see we've added the 5th decimal place there. If you check 1 hour later and the price has increased to 1.1310. Now, how much has price increased? Remember, the red number is a pipette. Okay, we're not interested in the pipette, so don't even look at that. Put it on there for learning purposes. When I'm actually trading, I totally disregard it. The yellow number is the pips. Okay, so we've gone from 1300 to 1310. Okay, so yes, we've increased by 10 pips. You simply work that out, how many pips the price has moved by taking the larger price and subtracting the smaller price. But we also have tools on TradingView, like I showed you in episode 1 of the TGS mini series, where we can use our measuring tool so we can gauge the distance, and also our risk reward ratio boxes, which is the green box that I use. And that also, we can drag that out and that will work out the pips for us. So we don't actually have to physically get a calculator out and work it out. We've got tools on TradingView which will help us with that. Okay. So an example for yen here. Let's say the price of yen, Euro JPY, is currently 118.651. Now remember, the red number is the pipette. Okay, we're not interested in that. We're only interested in the 5 because that is the pip. Then obviously, if we've gone up in tens, we're looking at the 6.5. Okay, so you check 1 hour later and the price has increased to 118.75. Again, that's an increase. Okay, the yellow number is the pip and the red number is the pipette. Okay, in this example, the price has moved 10 pips again. So it went from 65 to 75. Okay, you can simply work out how many pips price have moved again by subtracting. But however, we have got those tools like I've just explained on TradingView. So pips is very, very important for us to understand and know how to work them out. A lot of people include the pipette when they're doing their subtraction. And what happens is they think they're using a 30 pip stop loss. They're really using a 3 pip and then get stopped out the trade straight away. That's even if the broker lets them place a trade, because sometimes with the spread, you won't be able to place a trade depending on what instrument you're using. So it's important that you get that right, because you don't want to get stopped out too early, and you also don't want to hit target too early. You don't want to take a 3 pip profit where you're really going for 30 pips, for example. So pips, very, very important to know and learn. Screenshot this, of course. You're welcome to take it away. I'm going to put a little mini booklet together like this and put it in that Telegram channel for you guys to download as well. Just so you've got a bit of an idea and something to take away with you, including the risk management stuff that we've gone through, and of course the guide, the risk management guide and the lot size guide, which is going to be awesome for you going forward. By the way, you can just print the guide out. What's my lot size got to be for this trade? It's going to be there. A good approx figure for you, rather than you have to scramble around and rush around and try and find that. It'd be there ready. So that's a great useful tool to have. So pips, really simple. Just remember second decimal place on yen, and of course fourth decimal place on all other pairs, Euro USD, GBP USD example. Okay, so I hope that has cleared up pips of everybody. I have got a video which actually breaks this down really nicely. It's an animated one. When you go into the Golden Suite, just go to TGS1, that'll unlock about 15 videos, and you'll see it in there about pips. Okay, so risk management, very important. Any questions about pips? Okay, what is the best risk to reward ratio? Now, with risk to reward ratio, I mean, the best is obviously higher the better. I mean, the more frequent that I seem to find is 1 to 2. I mean, you can find a lot of 1 to 2s in the market, which are pretty common and very easy to get a nice stop loss there and a good TP. 1 to 3, 1 to 4, 1 to 5s. The higher you get, you're starting to get into more swing trading territory. But on a day trade, you can achieve 1 to 4s, 1 to 5s as well, very nicely. But the most common I see, I'd say 1 to 2 and 1 to 3s for my day trading style. Yeah, so with the techniques and strategies that I use, you find them a lot. I mean, a lot of people struggle just to get 1 to 1. But once you know what you're looking for, you can find the 1 to 2s, etc. very, very comfortably. How do you count pips on gold? I don't trade gold, and I can show you, but I'd have to get a chart up, but I haven't got one up right now. But be careful, because when you do your drag tool, the measuring tool on TradingView, okay, it would say, for example, 500 pip movement. It's not. It's just 50 and multiplies it by 10. So just be aware of that. It's not a 500 pip move. It's 50. I don't know why it does that. It just does. Okay, so just be aware of that. Also, when you're doing your risk to reward ratio box, just be aware of that on gold. So you don't be caught out on there thinking you've got this huge stop loss when you haven't, and you've used a very minute lot size because you think you've got a 500 pip stop. Really, you only had 50. Then your profit's going to be a lot smaller than what you expected when you do hit target. Okay. Any more questions from anybody? So we just recapped on risk management and pips. Very simple. Need to know. Okay. Yeah. Currently says I got 1,000 pip stop loss. Yeah, it will, but it's not. It'd be 100. Okay. That's the gold for the gold question. These videos, some are going on YouTube today, some will be uploaded over the weekend, so everything will be on there for you to recap on. Next week, we're going to be jumping into Japanese candlesticks. We're actually going to be doing a lot of chart work, so this is the foundation stuff that I'm giving you before we actually get into the really cool stuff. You know, marking up the charts, finding zones, looking for opportunities and stuff like that. Okay, so I'll be giving you a few really good tips next week. I'm going to be giving you some homework and some tasks to go away with and practice and start molding you into some decent traders. Okay, so thanks for tuning in. Yes, I will have a great Easter weekend. Thank you. So I'm going to do a lot of fun stuff with the kids, which should be good. I hope you all enjoy your Easter weekend, and yeah, enjoy. And don't forget, bank holidays like today and Monday, the markets will be slower. So try not to force any trades for those of you that are trading, okay? Just chill out. There's not much opportunities there. You don't need to rush into anything. There's nothing there Monday. We'll just wait till Tuesday till the markets start picking up a bit of liquidity and the banks are trading again in the UK, and then we can start looking to take some trades. So just enjoy the downtime, get back testing, make the most of the weekend, and yeah, have fun with your family and friends. Take care, everybody.